What's up, everyone? It's Scotty with Money Investing. So we are going to be talking about the banking sector and how it's evolved and it still is evolving moving forward, and why it's now starting to feel a lot more like a monopoly of some of the biggest banks that we have. So I'm going to break down, and again, I took actually a lot of time. I spent a lot of time kind of gathering all this data and putting it all together into spreadsheets and then eventually in graphs, which you will see in this video. So I would really appreciate a thumbs up on this video. So make sure that you drop a like. And of course, don't forget to subscribe to the channel if you're just joining us for the first time. We're trying to get to 75,000 subscribers as soon as possible. And the link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas, and a lot of other research and analysis and private videos and lectures as well. So if you haven't checked out already, I would highly encourage you to check out the testimony from Treasury Secretary Janet Yellen. And there was a very specific question asked from Oklahoma Langford, and he basically was asking about the regional banks, some of the smaller, medium-sized banks, and whether their deposits, uninsured deposits, are going to be made whole, and are they insured? To which Janet Yellen pretty much said no, they would not be insured. And the reason is because Janet Yellen, with the FDIC board and the Federal Reserve Board in consultation with the president, will determine if that bank is actually a systemic risk to the entire system. If the answer is yes, then the depositors will be made whole. If the answer is no, the depositors will not be made whole. Now, that is a very, 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 very broken system. I don't know about you, but as soon as I heard that, my mind was just blown. It was absolutely crazy to just hear that. And to summarize, pretty much on Reddit, I saw this, which was very, very interesting. All banks are equal, but some banks are more equal than others. That's what it sounded like, because if you have a regional bank, if you have a small community bank that is not at the same size and scale as something like a JP Morgan or Bank of America, they are more susceptible to going down and the depositors actually bearing the cost for simply parking the cash at those community banks if there were any bank failures. In other words, the FDIC, the Treasury Department, and the government would not step in to save you if you have money in any of these banks and they were to fail, and if they don't pose a systemic risk to the entire system. So it's actually quite crazy to think about, and I think this is a very, very broken system in my opinion. Let me know in the comment section down below, and I've got some charts to show you which will kind of put the nail in the coffin in the entire banking sector. So one of the most interesting charts is the number of banks, right? So number of banks that have existed in the US over time. And you'll notice that since 1934, so we're actually going back quite a lot of years here. And again, I put this all together in a spreadsheet that might be available for all the members. I'll see if I can make it available. But as you will notice, that since 1982, 1976, and 1988, like around that time, there were almost 15,000 banks, commercial banks in the US under the FDIC's insurance. Now that number has dropped 75%. It has now come down to under 5,000 banks. It's dropped 67 to 70% in the last 40 years or so, as you have seen a massive consolidation in the banking sector. You've just seen one bank gobble up 10, 20, 30, 40 banks in the last 40 years. JP Morgan alone has acquired close to 45 to 50 banks in the last 40 to 50 years. I don't quote me on that, but as much research as I did, the number was 41 to be precise in the last 20 years, but I was not able to confirm that report. Bank of America has acquired close to 14 to 15 banks alone in the last 20 years. So you've seen this massive consolidation of some of the biggest banks in the world, especially in the US, of course, biggest in the US, just gobble up literally on the smaller to medium banks. That's what's happened here as the industry's consolidated so much, and now we have under 5,000 banks. Now, what's happened also during that time, as these bank numbers, so number of banks have gone down, the deposit base, right, the total bank deposits has swelled up to almost $18 trillion. That number has literally skyrocketed. And that's a good thing, right? People are saving, people got deposits, individuals, banks, governments, everybody has deposits in banks. But how have these banks benefited from it? Well, if you take a look at deposits per bank, that has grown at an exponential rate. It has literally gone from under $1 billion in deposit per bank, because there were so many banks at the time, to now almost $4 billion deposit on average per bank. That's a pretty substantial number, and that just goes to show how we have seen such a massive massive amount of consolidation. Of course, that's just the average amount. Obviously some banks are going to be higher, some banks are going to be lower, but that's simply taking into account the total bank deposit base and then dividing that by the number of banks. And as the number of banks have come down, deposits have continued to grow. Deposits per bank have exploded to the upside. In other words, the banks that are now existing, so the leftover banks now that have acquired so many others, are able to take the advantage of the higher deposit bases and able to lend them out and take advantage of the higher interest rates and yields and able to generate a lot of revenue as we have seen this consolidation, right? Because it's starting to feel a lot more monopoly, like even though 4,000 banks is still a lot of banks, but when you consider the top 10 or the top 5 considered as the SIBs, I mean, they alone control, 50 to 60% of the deposit base at the moment. This right here is going to be the credit card debt. And again, you can, as we can do with the deposit base, the credit card debt has also exploded to almost $1 trillion as of 2023. I think the most recent print, we're sitting at just under $990 billion. And credit card, again, at the highest interest rate bracket. I mean, if you have a credit card debt, you're probably paying 25 to 30% in current environment. And credit card debt per bank has also exploded to almost $25 billion. At one point, this number was under $4 billion per bank in credit card debt. This right here is going to be mortgages. So mortgages have now exploded to over 13, almost actually $12 trillion, almost sitting at $12.5 trillion. And you can see how exponentially the mortgage debt has grown in the US from 1950s. This is going back as far as 1950s years, 70 plus years. And mortgage balance per bank also grown exponentially. And again, it's kind of like the effect that this is having with the banks going down and these balances going up. The remaining banks that we have are able to just take advantage of substantial amount of deposit bases, lend out loans at a crazy volume, take advantage of higher interest rates, and the worst thing, collect massive fees. The fees collected per bank has also been exploding. At one point in 2000, it was under $1 billion, and that has 4x'd in the last 20 years. It's gone to over $4 billion. So, there's a lot of industry consolidation happening. And again, this is a very, at least in my opinion, not the best system, because then you've got pretty much everyone, all banks, all individuals, all governments, all businesses flocking towards the big four, flocking towards the top 10 SIBs, systemically important banks, and they have all the power pretty much to control all the money and the supply in the US if you are not taking advantage of community banks. Now, some of the other solutions to the problem here, number one, raising the limit, right? Restoring that confidence from the FDIC, I think, is going to be very, very important. This is, again, me just thinking out loud. You guys can chime in down in the comment section below. And what do you think is the solution here? Because if these community banks continue to get gobbled up by these larger banks, I mean, eventually there's going to be massive consolidation in the industry, and all we'll be left with is just a handful of banks that are large enough to be there, right? If they fail, I mean, the entire system fails. So I don't know if it's a good or a bad thing. It's certainly not a great thing because, at one point you're kind of concentrated on a few banks and they've got a lot of power already, and you're kind of flooding a lot of capital and deposit bases into those banks in the first place. But then, obviously it's a bad thing because it's going to be too concentrated among just a handful of banks as opposed to the entire diversified sector in the Midwest and, of course, in other parts of the U.S. as well. Right now, it's kind of too focused on the East and the West. The Midwest, a lot of community banks, a lot of regional banks are struggling, obviously, at the moment with seeing those outflows. So one of the solutions that I was, again, thinking out loud was the idea of raising the FDIC limit, right? So obviously, $250,000, I mean, that limit has gone up. But with companies having hundreds of millions of dollars, billions of dollars in the bank, they need higher limits. I mean, that shouldn't be a surprise, right? We obviously need higher limits. And another solution that I think Charlie Bilio came up with on Twitter, which I think was very interesting, is that buying additional insurance policy based off of your balance. So for example, $250,000 is covered by the FDIC. Anything above that amount, you pay a percentage every month or every year, and you buy insurance for that additional amount. So for example, if I have, let's say, $1 million in one bank, $250,000 is covered, and the remaining $750,000 of uninsured deposits, I pay, let's say, 0.5% or 1% on that. That's going to run me around $7,500 per year, which obviously I know it's a lot of money, right? You can do 0.5%, right? We can obviously debate on the percentages, but that's the insurance policy that you can buy to make sure that you are insured in a bank failure, which I think is actually a good solution to the problem, which actually generates more revenue to insurance companies, more potential revenues to the banks, but at least gives the depositors a peace of mind that, okay, even in the event of a regional bank going down and the Treasury Department not stepping in, FDIC not stepping in on uninsured deposits, at least I'm safe, even though I've got a higher amount because I bought the insurance policy. Something, definitely to talk about. It's something to consider from these banks. But yeah, I just wanted to kind of break this down. Let me know your thoughts on where we're headed with the banking sector overall. I still have a long position on FAS. I'm going to be potentially buying even more because, at the end of the day, I mean, it's the big banks that are going to survive and thrive. It's just a matter of whether the regional banks and smaller community banks are going to be able to survive with them, or are they going to be acquired? Because there's been a lot of M&A activity, like hundreds of banks have been bought up over the last several years from some of these bigger banks. And it's just the industry overall is just crumbling in terms of the number of banks out there. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. And again, let me know in the comment section down below, what do you think about this? Subscribe to the channel for joining us for the first time. The link to our Discord and Patreon is going to be down below. So always happy investing, and I'll see you all in the next video.